Well, let's talk now to Marc Ostwald, who's Chief Economist and Global Strategist at ADM Investor Services. Welcome back to the programme, Marc. Good to have you with us. So these numbers in the US look like inflation is on the way down. Can we say it's peaked? Is it now a downward trend?
It's on a downward trend, but it depends on how far. I think the disappointing elements of it were that housing and particularly household utility pressures aren't really dissipating as much as many people have been anticipating. They will start to dissipate more in coming months. But the real question in terms of the central is in terms of the central bank, and the central bank won't be happy with the fact that if you look at the measures they look at, which is annualizing the 3 month change in CPI, which is 3.1 still, and the 6 month is still 4.5. They want to basically hit 2. And what they're concerned about primarily at the moment is it gets to 3 but not 2, and that would be above their target, so they feel they will be beholden to keep on tightening interest rates.
So you say the Fed won't be happy about these figures. What else will the Fed be considering when it comes to interest rates?
Well, they'll certainly be looking at the labour market. They've got a tough task there because the labour market is very, very tight. Labour demand is still very strong. But part of that is due to demographics. We know that a lot of people have been retiring early because of the pandemic. And that basically means there is going to be this persistent labour skills shortage, which is complex because if you've got a shortage of labour supply and inflation, you're going to keep the underlying wage pressures on the wrong side of where they'd like them to be. And that's really what they've got to make the judgment for.
On the surface, though, things look pretty good, don't they? We've got inflation potentially improving, energy prices on the way down. So what are the main issues for the US economy at the moment?
Well, what we're looking at in terms of forward-looking indicators in terms of demand, above all in the manufacturing sector and the services sector, is that orders do seem to have fallen actually very sharply towards the end of the year. And there's a forward-looking measure that does suggest the US is definitely a risk of recession in the not-too-distant future, certainly by the second half of the year. This may be, on the other hand, temporary. Those measures are... There's too much being read into, as far as I'm concerned, 1 month change. And sometimes you can actually get very errant readings. But at the moment, there does seem to be quite a sharp loss of momentum. And a lot of that actually has to do with the rise in interest rates and the overall inflation pressures which companies are having to absorb now.
And what does this all mean for the strength of the US dollar?
Well, I think it's sort of... The strength of the US dollar is in part because of the relative interest rate differentials to most other countries, particularly developed countries. But if we get into a situation where the Fed is about to stop and the ECB still seems to be on a tightening path, then one can certainly say that it's likely that the dollar is likely to lose some of the luster that it had. The only counter to that is that the world has a big global debt problem, and most of that debt is denominated in dollars. So the rest of the world will be still chasing dollars to pay down the debt that they've got.
Marc, good to talk to you. Thanks for joining us today. That's Marc Ostwald from ADM Investor Services.